Okay, thanks everyone for joining me. Thanks for having me, David. And we're going to get started here. We have a lot of material to cover, and obviously there's a lot of volatility going on. So I thought maybe this was a good opportunity to talk about hedging your portfolio using options. We have a unique options trading technology, and we're going to look at some automation with options in terms of risk and profit management. We'll look at pre-built option strategies. We have a unique strategy as well. And some of these are higher probability setups than others. And then we have a special one-touch alert technology. So when you issue, we'll issue a trade alert to you, and all you have to do is respond with one touch of your screen. All right. And let's get the preliminaries out of the way here with talking about speculation. Of course, we're trying to make money as markets move up and down, but there's always risk. And with that said, do take a moment and please look at the risk disclosure. Remember, really the most important thing here is you should only be using risk capital when you're trading, and past performance is not a guarantee of your future results. Just a little bit about AltaVest. Since 1997, we've been an introducing brokerage firm. We have decades of experience, having traded millions and millions and millions of contracts over the years. And that's yours truly there in the middle, down on the trading floor with some of our options traders. We are registered with the CFTC, member of the NFA. We're located in California. So those are the regulatory agencies that work within our industry. And of course, over the years and decades of experience, I think that somewhat qualifies us as a bit of an expert in the space of futures and futures options contracts. You may have seen us a few times every month or so. Places like MarketWatch and other various outlets may quote us and ask us for our thoughts on things. So here we are just a couple of days ago on MarketWatch. And just a little bit about myself. I am Erik Gebhard, doing this about 30 years. I have my license from 1991 in futures and options. I have a BS in business administration from USC, the Trojans. Maybe you've seen some of our other presentations as well. So I got started way back when. Sometimes people ask, and it's kind of boring, but it just so you know, I was in the mutual fund industry with annuities. I had my Series 6, 63 securities licenses. And of course, I currently have my commodity futures Series 3 license and my Series 65 investment advisor license as well. So with some of those preliminaries out of the way, let's just jump into some of the happenings here. It's probably no secret, obviously, to any of you what's happening with the stock market now. A lot of increased volatility. We're already off our peak. The Russell, Bitcoin made highs in November, the NASDAQ as well. And here's where we are now. This is just as of yesterday evening, I guess. I couldn't get the latest. It didn't have enough time, but Russell down 18%. Bitcoin getting hammered. All the crypto space here down 45, probably closer to 50% now. NASDAQ down over 11%. So you're now in, I guess, what you would call correction territory on that. The Russell is probably in a bear market territory, down 20%. So that's what's happening. And what's going on with the 10 and 2-year yield curve, if you're not familiar with that, just the 10-year yield minus the 2-year yield on the Treasury. And of course, the faster it flattens or approaches zero or even gets inverted, the more likely stocks will sell off along the way. In fact, that's one of the biggest trigger points, is an inverted yield curve in terms of indicating a recession. Here's what it looks like right now. So you can see we're dropping and dropping and dropping, getting closer and closer to zero. So interesting, keep an eye on that. Wall Street's predicting 4 Fed hikes this year. I think the Fed funds futures markets might be not quite at 4 in terms of their prediction, but they're also shrinking their bond holdings. But what happens if the Fed hikes? Well, we're kind of, I guess the markets are front running that narrative right now. So the economic growth is already decelerating. And if the Fed does hike rates 4 times, then stock market volatility will certainly expand and then remain elevated for a period of time. Of course, that's an inverse relationship with stock prices. As the VIX increases and stock prices plummet, here's what the target rate here. The suggestion here is over a 92% probability in March that the Fed will hike rates. Of course, as the market drops, this probability actually decreases. So we might be today in real time a little bit lower. Rate hikes may trigger a recession or a market crash. You get a lot of this. I'm just throwing some of this out here. This is kind of a good one to read, so we'll go through it. It says, being late to the game is the Fed's MO. It appears they mistimed this one perfectly. Economic growth is beginning to slow stateside, but Powell is now in a position to repeat the mistake he made in Q4 of 2018, in which the S&P's total return was negative 4%. So let's keep that in mind. History doesn't always repeat itself, but past can be prologue. This is a good one too. The US consumer is tapped out, and the Fed erred last year and allowed inflation to run red hot. And in 2022, it won't spot the economic slowdown in time. It will keep tightening right into a major recession. Something to keep in mind, you can see back in 2018, the taper tantrum. The Fed here, they tried to hike into an economic slowdown. The market choked on that and they reversed course. You see the pandemic slowdown there, of course. Now here we are. So we shall see, folks. But I guess the point of what we're going to talk about is how to prepare for that. And economic data, we'll go through this quickly. Home prices decelerate for the 4th straight month. Initial jobless unexpectedly surge to a 3-month high. Economic slowdown deepens. Latest confirmation the economy is slowing rapidly. U.S. existing home sales suffer biggest December drop since 2009. Lizanne Saunders with Schwab, she always has great stuff. Consumer Comfort Index dropped significantly. It's now at its lowest since 2020. IMF just released their warning this morning, slashing global GDP growth. They warn on aggressive Fed tightening. What about inflation? Look at oil prices, folks. They're not going anywhere at the moment, not showing any signs of reversing. And what's the point of that? Well, energy, oil is a big portion of the CPI. Excuse me, I've got a frog in my throat. So the CPI is not likely to moderate any point soon, and the PPI. So that will keep pressure on the Fed to raise rates into an economic slowdown. So of course, the Fed is trying to stave off inflation, but they're in a bit of a catch-22. They've got themselves into a box. So if they hike rates, that causes the market to crash, at least historically. So US consumer prices soaring at their fastest in 39 years. Here's headline CPI. Look at that big spike here. CPI for housing going ballistic. PPI prices surging to record high. The services costs soar. Look at that chart. So with that said, let's just jump into some of these 3 barriers that all of us face, even the professionals. So let's see if we can relate to this. I want to, maybe you guys can chat, you guys and gals in there, and mention in the chat there which one you relate to most. But I think there's 3 hurdles. I kind of narrowed it down here. First of all, day trading, it's not that easy. If you're doing it successfully, keep doing it. You found a formula that works for you. But a lot of people just jump into it thinking they can do it as a side hobby. But really, there's less than a 1% success rate according to many studies. Here's a great article here. Just point out real quickly some of the yellow portion here. Schwab ran a study on a 6-year period of time. Active traders substantially underperformed a simple low-cost index fund. And look at this trade study here in Taiwan, 15-year period of time, less than 1% of the day traders consistently beat the market, 80% lost money, same out of Brazil. Very interesting. A lot of that, I think, is just, well, we'll find out why that is, but here's a great piece in the Wall Street Journal. I won't dig into it, but it says staying popular online means never criticizing a stock. So you're always bullish. You have these kind of things on social media, making 46 million, making millions here. This kid's 18 years old. He says trade with 500 times leverage. And this kid here says he's flying around in this helicopter. He's presumably a billionaire or something. So that's what you call narrative trading or story trading. And in the long run, folks, that's probably not going to work. But even if you are trading, are you beating the market? So this is an interesting study by Mark Skousen, an economist. It says in a simulation here, they ran with a trade simulation. They said here that basically monkeys or the simulators outperform the benchmark index by an average of 1.7% per year. So a little bit of humor there. There's your fund manager. That's the person you should hire, or the creature, let's say, you should hire. And the third hurdle, emotions. Okay, this is a good quote. It can be expensive trying to convince the markets that you were right. I think we've all done it. We've all stared at the screen. The market, that can't be right. That can't be right. Why is it doing that? Well, you're going to end up broke if and in the grave here, still thinking the market was wrong. Remember, the prices aren't wrong, only we're wrong. But a lot of this is based on noise. That's what causes us sometimes to make moves when we shouldn't. You have all the bulls, the bears, the talking heads, business channels, you name it. Puts us on that roller coaster, that cycle of market emotions. You can see here, we've all probably ridden this ride too many times. You start off and you're optimistic and euphoric as you're making money. And then as you're losing, you wave that white flag and you puke at the bottom and sell the lows. And then you get depressed, but then something else happens where you got a new opportunity and you're optimistic again. We want to step off of that roller coaster. Motley Fool says there really are three common biases when you make investment decisions, and our worst financial enemy is ourselves. I think that's probably a fair statement. And there's confirmation, there's anchoring, and there's recency bias. Won't go into all those details, but I think we get the idea. And I think this one little image here sums it up quite well. So as we come out of a big bull market here, obviously you can almost throw darts in certain, well, heck, in 20 after the pandemic bottom, you could buy anything and the market just took off and everyone felt like a genius. But as we know, in the long run, it's not that easy, folks. And look at what's happening in the last month, as we can look back in time and think, wow, the market giveth and the market taketh. So with that said, remember, two algos are dominating the landscape, and they, of course, have no emotion or bias. What percentage of trading in the markets is algorithmic or systematic or really institutional? Well, it says here, JPM estimates that systematic trading is 90% of US equity trading volume. Bloomberg points out that robots are now outwitting humans on their investment picks, and that should be no surprise. So that's what we call revolutionary trading. And here's what it used to look like in the caveman era, the dark ages of trading. Just one of our visits down on the trading floor. It's quite a few years ago, maybe 15 years ago. Of course, there's nobody there now in terms of pit traders and whatnot in certain markets. Things have definitely changed and gone, well, algorithmic. This is what it looks like now. So no emotion, automation, built-in risk, profit controls, you name it. This is our competition, folks. So, but how can you use algorithms and technology when trading options and spreads, and how would you be able to hedge your stock portfolio? Well, we're going to give you some ideas, some strategies that you can use. And we're going to look at trading in the futures market. So we're trading indexes. So futures index options on the S&P, NASDAQ, the Russell, for example. And why do we focus only on that space? Well, first of all, an index is less volatile. So, an index may move 3% in a day. That's a pretty big move. We saw that actually just yesterday in some of the indexes, if not more. Individual stocks can move 10, 20%, even 50% in a day. And of course, you have the ability for portfolio protection when you're trading an index. So you can hedge against market and broader market declines. And then if you're trading an index, you really are looking at just one or two markets or indices, not tracking 6,000 or 7,000 different securities, stocks and ETFs. So with that said, let me show you. This is a little bit of context and background for what we're going to focus on in just a minute here. But I think this will kind of lay the groundwork and give you some idea of why we're doing what we're doing. But we have a lot of our strategies are non-directional and they're collecting premium. And we're going to show you that and then jump into some of the hedging strategies, which are directional, of course. but people call this kind of weird, so I use that quote there, weird strategy. It's called a Dragonfly. It's a six-legged option spread, something we came up with a few years back and built some technology to handle it. So it's collecting premium on both sides of a market. In this case, we're going to look at the Eminis, like the E-mini S&P 500. And it's a variation on an iron condor. If you're not familiar with it, that's okay. We'll have some Q&A a little bit later, but this is the structure of a Dragonfly. You're essentially selling 4 calls. You buy 3 further out and then 1 closer to the money. But the net result is you collect premium for doing this, and then the same structure on the bottom. So every Dragonfly has the same structure. So with that said, what about some option strategies for just a bear market? Like we talked about, how would you hedge your portfolio against a downward move? Well, why not just do half of the Dragonfly and sell the call spread? So, and this of course would become profitable if the stock index decreases or even goes sideways or even moves modestly higher. So your same structure right here, you're selling the call side of a Dragonfly and you're collecting net premium. Remember, selling 4 calls, buying 3 further out, and then buying 1 closer to the money. And I want to point out that the one that you buy here, in this case, is only 20 points closer to the money. And I think in the other example, in this case here, it's 50 points closer to the money. So the algorithm is going to choose that for you depending on market conditions. And I'll show you how that works. But the point is that the one you buy, the one you own, is always going to be closer to the money. And therefore, it's going to gain in value more rapidly or lose value more slowly. Theta decay won't impact it as much. So that's really the key to this Dragonfly. And there's something we call a bear hedge. It's an asymmetric strategy. So it can basically gain in value if the stock index decreases enough. And it's really selling an out-of-the-money call spread. You collect the premium. Then you use that money to buy an out-of-the-money put spread. Here's what it looks like. So the market's trading right here when you place this spread, for example. And, or I'm sorry, this is just going backwards in time and showing you where the market was trading. And now here's the market right now at this level in this example. So you sell an out-of-the-money call spread and you collect the premium for selling that spread. And at the same time, you use that money you just collected and you buy an out-of-the-money put spread. And of course, if the market keeps dropping, quickly enough that is, you're going to make money more than likely on this put spread that you own as well as the call spread that you sold. But the question people, of course, and clients have is, well, you know, how do I know which strikes to choose, which expiration, which market? How do I know what strategy to apply? How do I know the timing of my entry, of my exit? You know, how do I manage the whole position? Good question. Well, that's Theta Trader. That's the answer for you, folks. And these are pre-built option spreads. We have a proprietary algorithm, creates what we call theta trades on a daily basis. So strategy, automation, strategies for bull, bear, and flat markets, of course. That would be the non-directional premium collection strategies. And then automation, something called the RTI is the risk thermal indicator. So it's color-coded and it's fully automated to get you out of the market. So you don't have to babysit and watch your screens. So our Theta Trader software, we feel it's simple and effective for trading option spreads and then managing your profit and your risk. So it's time to jump into the demo. If I can manage my screen here, we'll be in business. So just one moment while I switch over. Okay, very good. If someone could type in there and confirm that you can see my screen, that would be great. Or can't, that wouldn't be so great. All right, let me go ahead and show you the Theta Trader dashboard. So this is what Theta Trader looks like. And we're logged in here to the platform, and you can see, yeah, it looks like we're good on the visuals. I can tell. The Theta trade section here is near the top always, and then you have your open short positions here. And I'll explain these colors in just a second. And any open long or bought positions. This is just a demo account, and you can see I use it for webinars and just what I'm doing today. And you can see current pricing and whatnot here. So the first thing you'll do is you'll notice that there are bullish pre-populated trades, bearish, and neutral or non-directional. You'll notice that the Emini S&P 500, NASDAQ 100, and Russell 2000 are the markets we're trading. We'll focus on the ES. And of course, I mentioned bullish, bearish, and neutral. And for starters, let's look at a non-directional strategy, or a real quick iron condor. If you're not familiar with that, it's simply selling a call spread and a put spread simultaneously. That's all it really means. And you'll notice that these are pre-populated. These are all built out by the algorithm, anywhere from 16 to 66 days till expiration. All the strikes are all pre-selected for us. And you'll see the maximum profit potential at expiration of every trade, and then your targeted annualized return on any one of these positions. Of course, the ones with the least amount of time are always going to have these huge numbers. So it's not realistic, of course, to expect those types of annualized returns. This is really here to compare one trade to another, just to give you some context in terms of the days till expiration. But here's what you do. You drill down, you click on any one of these. And the first thing I like to do is look at a graph. So here is the current market. Here's the call spread you're selling and the put spread that you're selling. And we'll go back and just look at some of these details. I won't spend all of our time, of course, on all these details, but you'll notice it's all laid out for you. Your expiration date, settlement value. This is how much your premium you're collecting. Your put risk, call risk, your commission, your capital, cash required. Here's your profit potential, targeted return on cash, and then your targeted annualized return. And in this case here, the puts that you're selling have a delta of 9.92. So what essentially that means is you have a 9.92% chance that this option would expire in the money. But it also means there's over a 90% probability it's going to expire out of the money. So that's why we're selling it. And same thing here with the call, 6.96 delta. So you're looking at 93% probability that these options will expire out of the money. So that's why the computer chose it, higher probability outcome there. And you can change the quantity to anything you like. You can see the cash required moves up or down as you do that. And then it's a sell because you're selling the condor to collect the premium. And then we'll go ahead and just place that order. And you can see it's right there, traded right there. And we'll jump back to the dashboard and we show you the Dragonfly real quickly, just so you have an idea what this looks like and how it works. So we'll jump into this Dragonfly. We'll look at this March into month. And you'll see again, here's the current market. This is the call side of the trade, the put side of the trade. And selling the 4 puts and calls, it's all pre-outlined for you. Again, you're selling the high probability outcome here that these options will expire out of the money, which is what you want because you're selling them. And we have a quantity default to 1. Maybe we'll do 2 of these right here. So then let's take a look at leaving the pricing the way it is. We'll place 2 of these and it's filled in the demo account. So that's the background for the basic Condor and Dragonfly, kind of a non-directional. But remember, we're going to look at some bearish strategies. And here's a bear hedge, for example. And we talked about that just briefly where, well, let's go ahead and take a look here. This is what it looks like, folks. You're selling this call spread and you're buying this put spread. If the market starts to really drop like it is now, these put spreads are going to explode in value, and the call spreads will decline in value, which is what you want because you sold them. And so there's a good example of a typical bear hedge. You can see the pricing is already figured out. The strikes are selected for you. You're buying it. You're buying this as a hedge. At the negative pricing, meaning you're paying $1.25 point. So $62.50. And just that simple. This is the put side and the call spread of that bear hedge. Now, there's a great feature called a trade simulator on Theta Trader. We can go backwards in time. And I will go ahead and show you. We can kind of back test these option spreads. Here's an example of a condor placed. I just chose November 20. And we'll use these tools here to go day by day forward in time. And you can see the green RTI, which is good, means do nothing. The trade is doing what it should. The P&L of the trade is going, it's red, negative, but it is getting probably close to profitable. Yeah, slightly profitable, and that's because of theta decay, which is what you want. So you can go day by day, or you can just use the play button. And now you see here it's getting yellow, so a little elevated risk, but still do nothing. And then it turns red. So you end up with a loss on this condor. Now, I want to point out that when it turns red, you can automate this. You don't have to watch it and close out the trade and place an order. So I'll show you how to do that, but this is very important for Theta Trader, and clients absolutely love it. You don't have to monitor and screen watch and babysit your trades. Theta Trader will monitor everything for you. But I just wanted you to point out that this is a typical trade. If you have a condor, you're selling premium and the trade doesn't work out, this is an example. So I just don't want people to think that we're only showing stuff that works, okay? So now, here is a Dragonfly. Now remember, this was, let me point out here, this is the November 20, 2019. So November 20 of 2019, instead of a condor, what if you had placed a Dragonfly? Let's watch what happens. And look at this, it turns blue, and that's the profit-taking signal. So instead of ending up at a loss like the condor, the Dragonfly trade actually was profitable. And the reason why, of course, is this strike here, this 32.90 call, is one that you bought, you own it. So it's gaining in value as the market's moving higher and higher and approaching that strike. So totally different risk reward dynamic and characteristic. I wanted to point that out. Now here is the bear hedge we talked about. This is a strategy you could use for portfolio protection, or just getting directional and getting, in some ways, short the market, the stock market. Now here we go, November 22 of just last month or 2 months ago, I guess. And we'll go ahead here and look at this. So you'll see that you paid $20 to buy this position, and the market kind of chopped around and then ultimately ended up dropping, just as you would hope in this case for this position, I guess, if you're speculating, and ended up making a profit of $1,300 and some dollars. So that's kind of a typical example of a shorter dated, shorter duration bear hedge. You only had 9 days till expiration when you placed it. And you see day by day, and as the market's kind of going sideways here, the trade's losing money, which is pretty common, but then it has a drop, a big drop. So now you can see it turns profitable. And it goes back up. You know how markets don't make it easy. And then, of course, in the final day, ends up being a nice profitable trade. And if you automated this, of course, you would have been automatically taken out of the market here at this level when it turned blue. And then here's another example of a bear hedge. And again, you can see you place the trade, the market starts kind of coming your way, and then it really declines. And then you end up in a nice position here where, ultimately you started off paying $72.50 and the trade ends up being worth 10 times more than that at the end of its lifespan. And this one here had 16 days on the expiration. So just a couple examples of a bear hedge. And of course, you can go backwards in time and you can, let me show you how that works. You can pick any date. I won't, or any strategy here, bullish, bearish, non-directional, choose any market. Then you can go backwards in time and use this calendar, and you can have a lot of fun going backwards in time and sort of have a time machine to your trading. So people love using this, and it's a very valuable tool, and you can backtest those six-legged dragonflies, or you can backtest a bear hedge. And I also want to point out too, let me just go back here to the dashboard. I know the focus was, so far been on maybe a non-directional or bearish strategy, but keep in mind too, there's certainly bullish strategies. You can do a bull hedge, which is the opposite if you think the market's bottomed. Also, if you're bearish, there's more traditional strategies. You could simply buy some outright puts. Theta Trader's chosen some strikes for you. You can sell some out of the money call spreads. Very simple to do that. You can simply buy some vertical put spreads. Maybe the February end of month. So that's what you're looking at here with the current market price, and then this is the put spread you'd be buying. So it all works the same way. So there's more traditional strategies available that you might be more familiar with. There's butterflies. We'll sometimes do those as well. And then of course you have the dragonflies and the condors as your non-directional. So just wanted to point that out. That's all available. Now here is where you would go to your account settings. And this is where you automate everything. So you activate the risk manager with this button here, profit directive right there, and then click save settings. And that's all you have to do for that RTI, that color-coded system or strategy, to monitor and track your positions for you. And here's how you would go at a glance. You can see on the dashboard, of course, how your positions are doing, or you can go to a page on your open positions here. And you can see there are 13 open positions. You can see at a glance how they're all performing. I wouldn't make heads or tails of it in terms of this demo account. Once again, I just randomly choose trades. And, for the most part, if you're selling condors, selling deep out of the money calls and puts with higher probability outcomes, obviously, statistically speaking, most of the time, those trades are going to make money. But certain market conditions, like right now, you're probably not interested in placing a neutral, market neutral strategy as much as you would be maybe a directional strategy. Also want to point out that one little trick here, you can also buy a condor. So, you don't necessarily always have to sell a condor. So in this example, instead of selling a call spread and selling a put spread and hoping the market stays in that range, you can actually buy a condor and just turn it around 180 degrees. So you actually buy the call spread and you buy the put spread. So you spend money on that trade, and you're expecting a large move to the upside or downside. So sometimes that can be a valuable tool ahead of a Fed announcement or something like that. Just wanted to point that out. Also, here is our proprietary research. We have our TradeScope newsletter. We do it daily. Gives an outline of what we're expecting, looking at the charts, also some forward-looking guidance, and maybe some global macro research. And then we also have our daily trading summary here, which is something we write, providing more of a narrative on Asia, on Europe, on the US markets, looking ahead, economic calendar. It's all in here. Any trades that were filled on the day, and the current price quotes. So people love using our proprietary research. And I'll also point out here, there's a help file. For example, if you're curious about the details on the RTI and the color coding, it's all available here. There's more strategy explanations here as well. So everything is available for you within ThetaTrader. It's sort of a self-contained tool. These are videos. These are all tutorials, but ThetaTrader is very intuitive. You probably don't even need a video. And educational videos if you want more detail on options trading, advanced strategies and whatnot. All the videos are available here within ThetaTrader as well. All right, let me jump back to the dashboard. And one other thing, we looked at open positions. We'll go to closed positions here. So you can filter any way you want up here, but right now I just have basically showing 20 of the last trades on the page. You'll see 17 winners, 3 losers, the total P&L, and the short positions or the sold spreads. There were 14 winners and 3 losers, and then long positions, there were 3 winners and 0 losers. And you can see all of the short positions in red, all the long positions in blue. So you can see all this at a glance. And again, don't make heads or tails of it or much of it just because, you know, once again, this is just for demo purposes. But here's an example of you can click on any one of the trades. So I just clicked on this bottom one here and you scroll down and you can see backwards in time. And this is when you place the trade here. And the market kind of went sideways and did exactly what you would want it to do if you're placing a Dragonfly trade. And then here with 23 days till expiration, you had a profit signal, the RTI generated and automatically closed out that position at a nice profit for you. So that's how you go backwards in time and look at your history. Okay, now with that said, let me jump over. I see a couple of questions. Yes, it is all web-based. Good question. But let me switch gears here and show you the best feature of all, folks. So yes, we can make it even easier. Our trade alerts, we talked about that. These are 1-minute trade alerts, meaning in fact, maybe even 10 seconds. So you'll receive an alert and all it takes is one touch to respond with accept or reject. And why is that? Because these alerts are what we call live. They're integrated with your trading account. So you touch accept and you place that order, or you touch reject if you don't want to place the order. And our technology handles everything else for you. Here's an example. You'll receive a text message with a link. You just click that link. It takes you right to the alert page. You'll get a graph of the alert. I want to point out here, it's can't quite see it, but it says sell 5. So the quantity is already pre-selected for you in your account. And it tells you here the net premium you're collecting, how much cash is required to place that trade, what's the days till expiration, your targeted annualized return, current price quotes, and gives you a graph, of course. So it's just that simple, all on one screen. And if you want to place that trade, all you have to do is just touch accept on your device and we handle the rest. Just that simple. Here's another one, but we won't show you the same thing twice, but just on a older phone. Okay, so with that said, we've been through the ThetaTrader demo. You've seen the trade alerts, and we're going to make you a special offer if you want to get involved and start using ThetaTrader and work with us. So our ThetaTrader software provides proprietary option spreads, all algorithmic generated, simple, effective trade selection. And then I think probably the better thing is the tracking of the trades. So the RTI will automatically close out the trade for you. And it's kind of almost on autopilot. And once again, one of those hurdles we saw was emotion. So we're really removing a lot of the emotion. And we can go backwards in time with the trade simulator. So back testing, we saw how that worked in some of those examples. People really like using the back testing, and it's a very valuable tool, but it's also kind of fun. So you have Theta Trades, the RTI, and the trade simulator. all available. That software valued at $3,588. And of course, the one-touch trade alerts, we saw how easily those work. Those are seamless. Everything's integrated with your account, and you don't have to get an email and log into another platform and try to copy something. And in fact, I say this, and it's true, because I get calls where people say, I have an alert service, and I went to my brokerage account and copied in the alert and typed it in, and I messed it up. And now instead of buying, I sold, and I've got a big mess. So you avoid all those problems with our trade alerts. And that service there valued at $4,464 for that software. So in the total here, over $8,000 for the Theta Trader software. But keep in mind, we are different because we're not just chatbots. We're real people with real experience, decades of experience. And part of working with us means you get a broker to work with you, or maybe you can call it a private coach. So you can share the screen with your broker, someone who's licensed, experience. You'll have a co-pilot. You'll develop that relationship with that person. Discuss your trade history and strategy moving forward. That's really an invaluable approach, I think. Service $7,500. I think it's more than that, but I mean, I've worked with people that have spent $25,000, $50,000 on education, and what we're saying is we provide what you need when you're working with us and using Theta Trader. So the Theta Trader membership includes the software, the trade alerts, and the coaching, over a $15,000, $500 value. And of course, this is a little bit corny, but we'll throw in the extra bonus pitch here. Remember, you get the proprietary research. We talked about TradeScope and our daily commentary as well. That's only available to Theta Trader clients. And of course, the online tutorials we briefly talked about, that's all just part of it. So to summarize, your Theta Trader membership gives you all of the software, all of the alerts, your private coach, and our proprietary research, a value of over $18,500. And when we were doing these in-person events, we would do this actually at $4,000 for the membership. And of course, we're not going to offer it at $4,000 or even $2,997. We're going to do a lot better. We're doing this online now. So we have sort of an economy of scale here. So we can offer this to you even less. We're going to do 80% off retail. So $597 for your Theta Trader membership. And yes, it is only one payment. I see people asking that all the time. So just to clarify, that's why it's in bold and underlined. That's a one-time payment, $597, lifetime member. There is the link where you can just enter your info and sign up and become a member. Here's my direct phone number. You can call me. Of course, it'll go to voicemail or bounce to someone else right now because we are on live. But here's the thing. Here's the thing, folks. No excuse. 30-day money-back guarantee. So if it's 29 days from now and you decide it's not for you, that's fine. Let us know. We'll refund that membership fee. So you have no risk on that membership fee. And, you know, we're not in the business of, you know, trying to twist your arm to stay with us or what have you. So if it's for you, you'll know it. And if it's not for you, you'll know it. Just that simple. But I would encourage you to take advantage of the offer. And it is only for a limited time. I think it's through a Friday evening, as I recall. And a few FAQs. Yes, futures and options are tax efficient. It's a big deal for a lot of people, and I don't blame them. You can lower your effective tax rate by over 10% on your gains just by trading futures and futures options compared to securities. So absolutely, that's a huge difference, big difference. And also, there's no more itemizing when you're doing futures trading. You just receive your result on your 1099, your P&L, and that's all you need for your taxes. What about IRA accounts? People do that all the time with us. Absolutely. There may be some different financial or experience requirements, but you can ask us for details. And, you know, why would you want to do an IRA? Well, I think Forbes kind of sums it up here. You can combat market volatility by investing in alternative assets through a self-directed IRA. So absolutely, self-directed IRAs, you can access these types of strategies. And why do we only do the Eminis? And for example, the S&P? Well, they're liquid, they're efficient, they're cost effective. And here's a bit of trivia I'm sure you probably didn't know. The E-mini is actually huge, folks. The E-mini S&P 500 outtrades all the ETFs in the globe by over 2.5 times. So the average daily dollar volume on the E-mini S&P 500 is enormous. So keep that in mind, and that's why we're involved in it. Here's an example here. In fact, compared to the SPY, it's almost 10 times greater in terms of average daily dollar volume. And again, all ETFs around the world, 2.5 times greater. So the E-mini is where the activity is. 5 additional reasons to trade options on the E-mini. Well, they're liquid, large volume. That kind of goes without saying. Look at this. Here's the E-mini futures, almost 2 million in December, average daily volume. So that means the options are very, very liquid. And here's a white paper by the CME group. It says the ES options you offer superior execution, cost savings of $4 to $15 per contract compared to SPX. So that's what you mean by a tight bid offer spread. Large market share, so you have all these strike prices and 100 annual expirations, so you have granularity and coverage. And what that means for us is, for example, if the algorithm is searching for a strike price or an expiration to build out a strategy, it's going to find it. If you try to do a Dragonfly in a typical stock, it just doesn't work. You can't do it. So that's what's important about trading in the correct marketplace. And of course, we talked about briefly just simplicity. Why track thousands of markets? We can track just a couple, 2 or 3 indexes. And also the margin use versus stocks is more efficient. And then there's a clear cost structure. And what am I talking about? Well, everything we're doing is not a security option. Everything trades at the CME group and on their electronic Globex exchange. If the CME group is the largest futures exchange in the world. And what this means is every order is treated equally. If you do just one order for one contract, it's not treated any differently than someone doing 100 contracts. Totally different compared to securities where they have payment for order flow. So when you submit an order, the brokerage is not filling your order, folks. They sell it. They sell your order flow to a third party market maker. The only reason they do that is because that market maker is paying money to get those orders filled because they can take advantage of the spread. And you end up with a fill price that is less advantageous. So you're saving a penny to lose a nickel on these, free trading websites. There's nothing wrong with trading quote for free, but it's not free. It says here it's just disguised commissions. So if you want a broker to work for you, pay a commission. Nothing of value is truly free. That's kind of one of those phrases I guess you hear from your grandparents. But I think it's true. And the question people have of what are our rates, our E-mini rate, excuse me, is 5.25 round turn all in. So what that means is you get into the trade, you get out of the trade, and that's it, 5.25. There's no additional fees on top. And here's the latest. I just took this from a big box brokerage firm online. Their rates are 2.25, but that's per side. And then they have clearing and exchange fees on top, and it makes it higher than what we charge. So our rates are competitive, and also point out that everything we do is net of all trading costs. So everything you saw in Theta Trader with the history, the back testing, the current trading, the results, whatever, everything is net of all trading costs. And yeah, everyone has different trading decisions. People ask about performance. Well, of course, everyone uses it differently. So everyone's performance is different, just like any person at any brokerage firm. All the people have different performance depending on what trades they take or don't take, or when they get in or when they get out. Okay, what size of an account? Well, if you want to do more than just one thing, you want multiple option spreads working at the same time, we suggest 25 to 50,000 as a minimum amount for Theta Trader. And if you do 50,000, we'll simply rebate that membership fee. And people love to take us up on that offer, and that's great. So people keep that in mind, folks. We'll just gladly rebate that membership fee to you if you get started with us 50,000 or more. And a few more FAQs, trading account types. We mentioned IRA, but all the usual stuff: individual, joint, corporate, LLC, trust. If you do something like a trust or LLC or corporate, it will take a little bit longer. But individual or joint account, those can be done sometimes in the same day. Turn that around and get your account funded, be trading within a day. And just to kind of back up, why are we even looking at this? Why should you care? Well, alternatives. We are an alternative investment, and it says here alternatives whose performance has a low correlation to traditional investments may improve diversification and lower portfolio risk. So, the bear hedge not only has a low correlation, it has an inverse correlation. So if the stock market's falling apart, something like a bear hedge strategy will actually gain in value. That's the idea, at least. So, and why would you even want to look at alternatives right now? Well, we kind of looked at it briefly, but our stock prices overextended. Here's what they look like in the aggregate. This is kind of the Buffett market cap to GDP ratio. Here's the mean, this dotted line. Here's the 2000 level, the 2007, and here we are now. So, everything mean reverts at some point. It may take a long time, but I don't know. You tell me. And here, we talked about the Fed fueling asset price inflation. Here's the red line, which is the S&P 500. And the blue line here is basically money printing by global central banks. I mean, if there's not a correlation there, I don't know what is a correlation. So that, the Fed starts hiking rates, stops some of what they're doing with their QE and their bond purchases, that dynamic shifts all of a sudden. Here's the Commodity Research Bureau. Commodity prices are elevated. That's all, not all, but in large part fueled by the Federal Reserve easy money policies and inflating, assets. And of course, that takes money out of our pocket. So, we're not only fighting the market, but we're fighting the Fed. We're fighting inflation. That's why you need to, consider doing something different, something alternative. This is interesting here, the 10-year stock market return. What's the forward cast or the, forward-looking projection? MarketWatch says the next 10 years don't look good because Americans already have a high allocation to equities, and that in itself is a contrary indicator. Basically saying if everyone's bought, then who's left to buy? This is a few months old, but generally speaking, the theme is still there. There's something called a R-squared statistic. I remember that from college. It predicts 70% of the changes in the stock market's 10-year return. And it says here that indicators projecting the S&P will produce a total real return of negative or minus 4.2% annualized in the next decade. And then unrealistic expectations. Once again, everyone's a genius in a bull market, but look at this here. The average US retail investor expects a 17.5% forward return. How about in December of 1999, the average retail investor expected a 19% annual return on equities. And guess what the actual 10-year return was? Negative 2.3%. So that's one of those things where, maybe, history is a bit of a guide and maybe it's not, but something to keep in mind. So here's what investors expect, 17.5%. And here's what advisors think is realistic. So almost a 10% gap between expectations. So that's why we like an allocation to alternative investments, something that's not correlated directly to a benchmark index, something that you can be flexible with. So if your portfolio is all stocks, that's very aggressive. Even the 60-40, that's still aggressive. Everything correlates to one in a market crash. And having something in the alternative space, I think makes a lot of sense. So for a Theta Trader membership, remember you have strategies for all market conditions. You have those pre-selected spread trades by algorithms. You automatic trade management with the RTI. And then you have those integrated one-touch trade alerts. And of course, bringing it all together under the umbrella with a personal coach. So there's our link. There's my direct phone number. A little bit of humor to end it here. This guy says, you said that you always invest based on your feelings. Well, how do you feel now? And the guy says, broke. So let's try to shy away and back away from using narratives and stories and feelings. We want something that's process driven, using automation and algos. We'll use options and strategies for all market conditions. So there is the final slide. And let's see, I got a few more questions along the way. Yeah, unfortunately, we can't work with Canadian clients, but that's a great question. We would love to. We have many people that want to, but the regulatory agencies and the brains and the suits in our governments just don't allow that. So yeah, everything is 5 1/4. That's correct on the commission. The performance, everyone's different, you know, just like any other brokerage firm. So Theta Trader is simply a tool. And yeah, the membership fee is $5.97, and that's to become a Theta Trader member and use our software and our services and have an account trading with us. Absolutely. And yes, if you sign up, become a member, and you pay $5.97, and then you deposit 50,000 and begin trading, we will rebate that fee. Yes, absolutely. So good questions. Let's see if there's a few others that I missed along the way. I would say this: if you're just sort of on the fence thinking, well, maybe not, maybe I will, maybe I won't, you know what? Sign up. And once again, if it turns out that you're thinking, nah, maybe it's not for me, my life changed somehow in the next 30 days, again, we rebate that to you. That's not our business. Our business is a brokerage and, you know, technology firm. And the membership fee is, you know, really actually it's there as a good filtering tool, to be honest with you. I hate that phrase, but I said it, just because, you know, this isn't something where someone with $2,000 or $3,000 or $4,000 can use effectively. So we just, you know, we just don't, it's just not set up for smaller accounts. And, you know, having the membership fee and then getting it rebated works out very well for the client and for us. But yeah, there is the link. Thank you for that, putting that in there. And let's see, one other question here. Theta Trader, yes, you can only work with commodity futures contracts, futures options on Theta Trader. So we're not trading individual stocks, only futures options with Theta Trader. So we can sometimes do something like gold or crude oil options as well. All right, I think my time is, does this give us access? Yes, we do have another platform. That's a whole other conversation. We have a proprietary automated futures trading system platform, and that's something separate, but you can certainly email me or call me about that, but that's a separate technology platform. Okay, that'll do it. I think my time is up.